This easy investing strategy gave me better results than anything else I've tried over the years. And we, as a community, use this over the past 5 years to make generational, life-changing money. And today, you're getting it for free. I'm going to give it away so you can take it, copy it, adapt it, do whatever you want with it so you can make the money. So put your wallet to the side, don't click nothing, don't smash nothing, don't buy nothing. Let's do this. So this is basically 40 things that comprise the system. I'm going to go one by one by one. This is going to be rapid fire. So let's get started. Number one, the stock market is not a scam. It feels like that sometimes. It feels like the game is rigged, but it's not. The stock market is not a fair game. Life isn't fair. Certain people have more money, more influence, more access to data. Sure, mainstream media is not your friend. Sure, but you have to play within the boundaries, within the rules. You have to accept the responsibility that your decisions are driving your results, nothing else. That's rule number one. Number two, you have to understand that it's mindset or bust. 90% of investing is all about mindset. People fail because they can't control their emotions, not because they cannot do a DCF. Number three, you have to be bored by your investing strategy. More boredom means more money. Very, very simple. If you're looking for drama, watch some reality TV. Your investing strategy has to be boring, has to be dry, and has to be absolutely mind-numbingly, shockingly not interesting. Number four, you gotta figure out what is intrinsic value. You have to understand valuations. You have to understand how to look at a business and analyze what it's worth. Think about buying a share, you have to think about it as if you're buying the whole company. That's the only way this thing works. And of course, number five, you have to understand the product. If you're going to invest in the company, you have to understand the products, the services, do the research, talk to clients. If you can't experience the product yourself, you have to be able to understand what they're selling, how good it is. Drive a Tesla, talk to Palantir clients. You have to do the work, you have to do the research. Number six, checking your app, checking your brokerage app every single day to see what's going on in your account is hazardous for your investing journey. When you check your app 18 times a day, trying to figure out what's going on, it's going to put you in an emotional spend cycle. Avoid checking your app more than once per week. Number seven, you got to embrace the index. I've talked about it many times. The index, the ETF, a broad market index, is the main component of every single portfolio because that thing is a living, breathing cheat code. It is undefeated. It is better than Father Time. This thing has to be a huge part of every single portfolio. And of course, you have to combine that with actual stock picks. You can't just rely on the index to take you to the promised land. You have to mix it up. You have to have a huge chunk of S&P 500 and then marry that with individual stocks that are going to be game-changing companies over the course of the next 15 years. Number nine, volatility is not the end. In fact, volatility is awesome. This is where real money is made. In my previous video, which I'll link at the end of this one, I've talked about this. Volatility, risk, different things. Volatility is when the market goes crazy. Short term, this is where the money is made because you can buy the dips. You can lower your cost basis only when the market is being erratic and volatile. You can't make real money when everything just keeps going up. And that means you have to embrace the dip. Buying the dip is hard. But when the market screams, don't buy, sell when everybody's panicking, when there is blood on the streets, even if that blood is partially yours, that is the time to buy. And this is lesson number 10. Number 11, if you don't understand the company all the way down to the basics, to the building blocks, what they do, the business model, what the company is, the CEO, what are the services, what are the products. If you don't understand these things, the first sign of trouble, you're going to sell. Because if the company just dropped 30% and you don't understand what you bought, how do you know if it's not going to zero? How do you know it's just temporary if you don't understand the business? Never buy stocks in which you don't understand the business. Number 12 is the Constitution. You know, in America, you can't legislate against the Constitution. You have to have your own investing Constitution, your own set of rules, which you will never, ever, ever break no matter what. And have that Constitution right in front of your face every single day when you invest. Number 13, you can't time the market. You can't control the market. The market is going to do whatever the market is going to do. There's nothing you can do. You can't hope it. You can't pray for it. You can't be angry. You have to accept the fact that you have no control over where and when the market is going to do its thing, up or down. You can only plan ahead. You can't time the market. Number 14, accepting boredom and understanding that doing nothing, hurry up and do nothing, that's Jack Bogle for you. That is the core of retail investing for the long haul. Accept boredom, accept the fact that you're not going to get excited from what you do, accept the fact it's going to be for the long term, and it's not going to be very, very exciting. Doing nothing and waiting, That's the way to make money long-term in the stock market. Number 15, you have to scout the competition. I mean, you can't buy a whole company, without checking the competition. Why would you buy a stock without looking what the competitors are? A competitor analysis is a must before you invest a single dollar. Number 16, never ever use margin. The same rule applies to everything in life. How you do one thing is how you do all things. If you're going to use margin, essentially you're investing money you don't have. You shouldn't buy things that you can't afford. You shouldn't buy stocks you can't afford. If you don't have that money, you should not invest. Never use leverage. Number 17, don't fall in love too much with growth stocks. I know I'm a huge proponent of Palantir and Tesla and a lot of other growth stocks, but basing your portfolio entirely on growth stocks means that if they 10x, good for you, you make a lot of money. But if the market tanks, those will be the first casualties and your portfolio will suffer. You have to have a balanced portfolio. Number 18, fear means opportunity. When everybody's fearful, you have to be greedy. It's not Warren Buffett's invention. It's just the way the markets work. You want to buy convertible in the winter. You want to buy a ski vacation in the summer. You always want to buy when nobody else wants that. You get the best price. Number 19, greed is your biggest enemy. Greed is danger. When the market is hyped up, when everybody's greedy, that is the worst time to invest, and you have to continue investing because we know timing the market wins above everything, but to continue investing slowly during greed and aggressively during fear. Number 20 is the whole beef between index fund investors and individual stock pickers. Stop it. The drama is irrelevant. Both are needed in a portfolio. Number 21, volatility is a tantrum. Imagine you're driving a car. Your wife is right beside you, your 3 kids are in the back, and they're throwing a crazy tantrum. Basically going out of control, throwing things, spitting, screaming, crying, yelling. What do you do in this situation? Do you give the wheel to your kids so they can drive you off the cliff? Number 22, only invest in wonderful, terrific, generational companies. Good enough is not good enough. You have to look for game changers. Good companies come and go. Great generational companies like Apple, like Amazon, like Microsoft back in the day, they're the ones who'll be here in 10, 15, 20 years. Don't go for great businesses. Go for exceptional businesses. Number 23, you have to have a watch list of companies you're investing in, of companies you are interested in. You can't just do this and pick a company. You have to research for the long haul. Warren Buffett researched companies for years before invested. Ron Barron researched Tesla for 4 years before he put a single dollar. Number 24, you have to rebalance your portfolio at all times. You have to rebalance to keep the balance between the different stocks. Also for your age, as you're getting closer to retirement. A balanced portfolio is very, very important. Number 25, never marry a stock. A stock is not your spouse. A stock is not your friend. Nobody cares. It's a business. As long as the stock is good, you should be in it. The minute the thesis breaks, the stock loses its shine. It's not as good fundamentally. Leave it, drop it. It's not your friend. It's not a cult. It's not blasphemous. Number 26, you have to focus on free cash flow generation, and a very important aspect of it also means the balance sheet has to be loaded with cash and very little debt. Companies that have lots of cash, very little debt, they have lots of freedom. Companies with a lot of free cash flow have a lot of freedom. Number 27, the silent killer. And no, I'm not talking about grandpa's farts, the ones that you can't hear, but you can definitely smell. None of that. I'm talking about debt. Debt kills companies. Debt is like a ball and chain. It slows you down. It's the opposite of freedom. I don't invest in companies that have a lot of debt. Number 28, give up on this whole, oh my God, the market is at all-time highs. This stock is at all-time highs. All-time highs are irrelevant. Timing in the market is everything. You have to stay. The only thing you need to do is make sure when it actually drops, and it always drops, nothing just goes up in the straight line. That's where you buy more. But staying in the market and dollar cost average at all times is more important than trying to guess if the all-time high is actually the top or not. Who cares? The next thing, 29, is all about finance media. Finance media is going to turn you into an emotional mess if you let them. Don't let them yell at you and get you to panic. Use them to stay informed, but nothing more than that. Number 31, bear markets are a great opportunity. They're not a bad thing. You have to understand them, study them, understand the frequency, the history. They happen a lot. And when they do happen, you have to understand it's not a bad thing. I wait for bear markets because just like in 2022, this is where we make the real money. We buy through the negativity, and then 2 or 3 years later, when everybody's buying at 85, 90, 100, we bought it at 6, 15, 20. The same thing every time. The cycle repeats itself. Number 32, I never invest in a company that doesn't have a moat. A moat means a defense mechanism against competitors, whether it's be legal, technological, or anything regulatory, doesn't matter. Brand-wise, it has to have a moat that prevents competitors from taking their lunch. Otherwise, I'm not interested. Number 33 is the Jack Bogle statement, which I absolutely love. Don't do something, just stand there. Essentially what he's saying is that overactiveness in the stock market leads to losses, and not touching your portfolio leads to money. Dead people outperform the living by a huge amount of percentage. It's not funny. When you don't touch your portfolio, you make money. When you fiddle around with it, you lose money. Number 34, dollar cost average into the afterlife. Dollar cost averaging, meaning buying a fixed amount at all times and buying more when it drops, is the way to make generational wealth. There's no doubt about that. Number 35, don't fall for analysts' price targets. Sell-side analysts, for the most part, are idiots. They're just there to tell you what the sentiment on the street is. These price targets are based on nothing. It's a bunch of horse baloney. Mostly, you can ignore it. There's a couple of them that are really, really good, but 90% of them are absolute clowns. Stay away from them. Number 36 is accepting the fact that you're not going to be an overnight millionaire in the stock market. The same people you see on Instagram, the overnight millionaires from stocks and trading, well, those are mostly scammers. If you want to be an actual millionaire, an actual rich person from the stock market, you have to accept and embrace the fact it's gonna take a long time. Number 37, I learned from Ashwath Damodaran himself, the man and the legend, one of the best company evaluators in the world. You have to see both the numbers and the story of a stock. Ignoring the story or ignoring the numbers means you're a bad investor. You have to combine both. Real world story, numbers, and make it all one. Number 38, you have to know when macroeconomics matters and where they're not. Now, Peter Lynch famously said, if you spend more than 10 minutes a year looking at macroeconomics, you just wasted 10 minutes. I don't know if I'll go that far, but basically, macroeconomics come and go. I said it many times before. For the past 15 years, we had a gazillion reasons to sell the stock market, to leave, wars, recessions, crashes, and yet we did 700%. At the end of the day, the stock market is not stopped by macroeconomics and geopolitics. Staying invested is the best thing you can do for yourself. Number 39, you have to understand the fact that the best 10 days in the stock market are worth 50% of your portfolio. Losing the best 10 days in a 20-year period, meaning 1% of days. If you miss those, 50% of your returns of the past 20 years will go to the toilet. Missing the top 40 days, which is 5% of days of the past 20 years, just 5% of these days will make you lose money in the stock market over the course of the last 20 years. Staying invested is the most critical, important part of this investing journey. And a bonus tip for those of you who have to gamble, some of you just feel like they have to have that urge, they have to itch that scratch. I understand. If you have to gamble, take a little bit of money, take 1% of your portfolio and play around with it so you can scratch that itch or itch that scratch, whatever you want to do. I don't care. But don't risk more than 1% of your portfolio doing that stupid thing like timing the market and trading. Thank you so much. Now, if you actually want to learn more and go deeper and join our academy, we would love to have you there. This is the sort of thing we teach in the academy. We'll teach you how to evaluate companies, how to build your own strategy, how to dollar cost average. We have a top stocks list, which we actually use as a starting point to research. We have weekly lectures, we have hangouts, questions. You have direct access to me. We'd love to see you in the academy. Patreon.com/Tom Nash. I'll see you there. Peace.